Here's what your financial advisor called diversification. 40 cents of every dollar you put into the S&P 500 goes into 10 companies. Not 500, 10. And 7 of those 10 are currently spending capital they don't have on an AI arms race that by the actual math needs to produce roughly $2 trillion in new annual revenue to justify current prices. That $2 trillion figure is almost exactly equal to the combined total revenue of NVIDIA, Microsoft, Apple, Alphabet, Amazon, and Meta across every product they sold in all of 2024. Not their AI revenue, everything, all of it combined. You think you bought a boring spread across everything index fund. What you actually own is a concentrated AI infrastructure bet wearing an index fund costume, and nobody sent you a memo when it changed. I've been investing for over 30 years, multiple hundreds of thousands of dollars in the market right now, skin in the game. I spent more than 10 years running my own business, surrounded by accountants and fiscal lawyers who showed me in actual documents, not elevator pitches how money moves behind the language of brochures. My strategy for most of that time was aggressively boring. Buy a low-cost S&P 500 fund, hold it, reinvest dividends, ignore the noise. The boredom is the point. The boredom is the strategy. That strategy worked for 3 decades. What I'm going to explain is how it quietly transformed mechanically, automatically, without any announcement into a different strategy than the one I signed up for. How AI caused that shift. Exactly what I changed. And why. With real numbers. And a secondary signal that ties all of it together in a way I genuinely did not expect when I started looking. Before I get into the specifics, I need to give you a framework I'm going to return to several times, because it's not a metaphor, it's a pattern. It repeats every single time a transformative technology reshapes an economy, and almost nobody identifies it while it's happening. I call it the shovel trap. 1848, gold discovered at Sutter's Mill in California. Within 18 months, 300,000 people flooded into the state. The obvious investment, the one everyone made, was gold mining. Direct exposure to the asset. These are the winners, right? Except most of the miners left with less than they arrived with. They paid inflated prices for equipment, competed against each other into the ground, and worked themselves to exhaustion for marginal returns. The people who actually got rich quietly, permanently, generationally, were the ones selling supplies to the miners. Samuel Brannan bought every pick and shovel in the Sacramento Valley before publicly announcing the gold discovery. He became California's first millionaire. He never held a pan in his life. Levi Strauss sold canvas pants to miners. You know what that brand is worth today. The shovel trap. In every major technological revolution, the obvious money flows to the infrastructure builders. The real wealth, quiet, boring, unglamorous, compounding, accumulates with the people using the infrastructure to solve specific problems for specific customers. It happened with railroads. It happened with fiber optic cables. It is happening again right now with AI. I'm going to keep coming back to this because it explains what pure financial analysis misses. In a few minutes, I'm going to show you a specific number one figure held by one person that I think reframes everything we're about to discuss. But first, let me show you exactly what changed inside the most popular investment vehicle in America. Because the headline statistic understates the problem. The S&P 500 is market cap weighted. Companies earn their slice of the index based on total market value. Bigger company, bigger slice. Automatic, mechanical. No one votes on it. No committee deliberates. In 2007, the top 10 holdings represented approximately 17% of the total fund. As of early 2026, they represent roughly 40%. 23 percentage points of concentration drift across 18 years, and the fund never changed its name, never changed its prospectus description, never issued a warning to anyone. It kept calling itself a 500 company diversified index fund while slowly becoming something else entirely. Think of it as a pizza, 500 slices. The whole point is the spread. You wake up one day and discover that 10 of those 500 slices now occupy 40% of the entire pizza. And 7 of those 10 slices are made from one ingredient, aggressive AI infrastructure spending, financed heavily with debt. Nobody asked you. The index evolved while you were busy living your life. The 10 companies holding that 40% are Nvidia, Microsoft, Apple, Alphabet, Amazon, Broadcom, Meta, Tesla, Berkshire Hathaway, and JP Morgan. Set aside Berkshire and JP Morgan, genuinely different animals. The remaining 8 are in a capital spending arms race centered entirely on artificial intelligence. And the numbers involved are not abstract. Microsoft committed approximately $80 billion in AI infrastructure for their current fiscal year alone. Meta announced 60 to 65 billion in capital expenditures. Amazon projected 105 billion in total capex. Alphabet committed 75 billion. These are the companies representing your largest positions in your diversified fund. They are burning cash at a rate that requires a very specific version of the future to even break even on. Goldman Sachs published research directly asking whether AI capital spending would ever generate adequate returns. Their conclusion: for these investments to justify current valuations, these companies would need to collectively generate approximately $2 trillion in AI-specific revenue. I said that number at the top and I want you to sit with it. $2 trillion in one new category. From companies whose total combined revenue across all their existing businesses is roughly that same amount. That's not a crash prediction. That's a description of how large the embedded bet actually is inside an investment most people think of as conservative. Here's what actually bothers me. Not that the investment might not pay off. Risky bets are fine when you know you're making them. What bothers me is the shape of the misunderstanding. You think you own a diversified, low conviction, spread across 500 companies position. You actually own a high conviction, heavily concentrated AI infrastructure thesis. The risk profile you believe you have and the risk profile you actually have are two completely different things. That is a knowledge problem before it's a money problem. You think the problem is that your S&P 500 is concentrated in risky companies. That's not actually the problem. The problem is that you think you own diversification when you own concentration. Those require completely different responses, and most people are responding to the wrong one. I looked at equal-weighted S&P 500 funds as the obvious fix. Every company gets 0.2%, regardless of size. Nvidia, which currently captures around 7 to 8 cents of every dollar in the standard fund, would get 0.2 cents. Clean, balanced, problem solved, apparently. I tried explaining the mechanics of equal weighting to my accountant. He listened carefully. So it automatically sells the positions going up in order to buy the ones that aren't. I confirmed that, yes, that's how it works. He looked at his coffee for a moment, and this was designed intentionally by professionals. It was not a question, it was a verdict. The structural issue is called negative momentum. When a company outperforms Nvidia in 2023, returned 239% in a single calendar year, an equal weight fund must mechanically sell some of it to restore balance. The winner gets trimmed, the underperformers get bought, and more trading means higher costs. Over a 30-year holding period, a 1% annual fee difference on a $200,000 initial investment costs you approximately $170,000 in loss compounding. Not a rounding error, $170,000 from a single percentage point difference in annual fees. Every year you pay that fee, you're not losing the fee. You're losing the compounded future value of the fee. That's the number nobody puts on the brochure. Equal weighting doesn't solve the problem. It trades concentration risk for performance drag. One problem replaced by a different problem. I needed something else. By the way, hit subscribe if you're finding value here. Otherwise, YouTube's algorithm may never show you my videos again. I read the boring documents, so you don't have to. One button. This is where the analysis opens into something larger. And this is where most commentary on the AI market stops, which is exactly why most commentary on the AI market misses what matters. The concentration inside the S&P 500 connects to a broader assumption that most US-based investors carry without examining it, that American market dominance is permanent, that putting serious capital outside US equities is something you do when you're either naive or performatively contrarian. That assumption has been wrong before, badly wrong, for long stretches of time, at moments when it felt exactly as obvious as it does today. 1900. The United Kingdom held roughly 24% of total global stock market capitalization. London was the undisputed financial center of the world. British companies dominated global shipping, banking, and trade. Putting significant capital outside British listed stocks in 1900 would have seemed, to most serious investors, like a category error. By the year 2000, the UK represented roughly 8% of global market cap. Not because Britain collapsed, because the world expanded and the center of gravity shifted. The map changed while people were staring at the territory they already knew. Late 1980s, Japan. The Nikkei index hit 38,915 points in December of 1989. Japanese manufacturers were outcompeting American companies simultaneously in automobiles, consumer electronics, and semiconductors. Japanese real estate was valued so absurdly that the Imperial Palace grounds in Tokyo were estimated by credible analysts to be worth more than the entire state of California. This was not a fringe view. This was consensus. Betting against Japan in 1988 felt like betting against arithmetic. The Nikkei recovered its December 1989 high in early 2024, 34 years. An entire generation of investors held Japanese equities through 3.5 decades of waiting to break even on an obviously correct technology thesis that came attached to an obviously wrong price tag. If you had been fully concentrated in Japanese equities in December of 1989, you would have needed to stay employed, contribute new savings, and avoid selling for 34 years to recover. Not to compound, to recover. Meanwhile, any capital you didn't have available in the early 2009 market because it was locked up recovering from a previous decade wasn't buying the single best buying opportunity in a generation. I want to be clear. I am not saying the US is Japan. The structural differences are real and meaningful. But the pattern isn't about the underlying facts of any specific economy. The pattern is about the psychological certainty that obvious dominance is necessarily permanent dominance. That certainty has been wrong every single time it became widely shared. This is why I moved a portion of my capital into a globally diversified fund. Not as a bet against American decline, as a removal of a structural requirement I shouldn't be making. That the US must maintain its exact current share of global market capitalization for the next 20 plus years in order for my retirement plan to function. A properly constructed global fund adjusts automatically. If the US continues to lead, it holds more US equities. If India, Southeast Asia, or a rebuilt European economy gains in relative weight, it rebalances toward those exposures. No prediction required. The fund tracks reality rather than betting on one specific version of the future. Good global index funds run expense ratios around 0.19% annually on $100,000 invested. That's $190 per year. Essentially invisible over a long holding period. Now, let me introduce the thread I'm going to weave through the rest of this video, because when I close it near the end, I think it changes how you read everything we've covered. Warren Buffett, 94 years old, the man who has described holding cash as one of the worst long-term investment decisions you can make. The man whose entire philosophy is built around the idea that the correct response to a panicking market is to be a buyer, and that patience is what separates serious investors from everyone else. The man who spent 5 decades proving it in practice by deploying capital aggressively into every major crisis that came along. As of the first quarter of 2025, Berkshire Hathaway held $347.7 billion in cash and cash equivalents. Not deployed, not invested. Sitting in treasury bills while the NASDAQ was printing all-time highs around it. This is the largest cash reserve Berkshire has ever held by a significant margin. He sold significant Apple positions at historically high multiples, a company he has championed publicly for years. He stopped making acquisitions despite having more available capital than at any previous point in Berkshire's history. I'll tell you what I think that means at the end of this video. Hold the image. $347.7 billion doing nothing on purpose. Now, here's where the actual opportunity lives inside this market. And this is the shovel trap coming back in its most practically relevant form. The dominant narrative around AI investing right now is straightforward. Whoever builds the biggest model wins. Whoever spends the most on compute controls the future. The arms race to infrastructure supremacy. The assumption embedded in the crowded zone valuations is that spending more money faster creates permanent winner-take-all returns. Let me tell you what happened to the long-distance fiber optic industry in the late 90s. After the Telecommunications Act of 1996 deregulated the industry, capital flooded in. Companies laid enough fiber optic cable to theoretically circle the Earth over 1,000 times. Global Crossing, MCI WorldCom, 360 networks, hundreds of billions of dollars committed to the most obviously correct technology of the internet era. The internet was real. The demand was genuinely there. The logic was as tight as logic gets. By 2002, most of these companies were bankrupt. The cables sat in the ground, dark, unused. Someone bought the assets at cents on the dollar. The companies that got genuinely, generationally rich from that infrastructure? Google. Founded in 1998 by two graduate students who never laid a cable. Amazon, which used the internet to sell books and then everything else. Netflix, which mailed physical discs for years and eventually streamed content over those same buried cables that its providers had gone bankrupt building. None of them built the infrastructure. All of them used it to deliver something specific that specific customers would pay for. Third time the shovel trap has appeared in this video, each time in a different century, each time following the same script. Now watch what's happening in AI in early 2026. A pattern is emerging among software companies that don't get cable news coverage. They're building products that let users choose their AI model at the point of use. Claude, ChatGPT, Gemini, whichever fits the task or the price point. The product is the workflow, the interface, the integration into an existing business process, not the underlying model itself. And here is what that pattern implies. As these models converge in capability, which for the vast majority of real business applications, they already have the competitive axis shifts from quality to price. A sustained price war in AI would be economically devastating for every company that spent hundreds of billions building proprietary models. It would be a minor vendor line item for a software company that switches providers in an afternoon. Think about how gasoline works. One station charges $1.50 a liter. The next charges $1.90 for premium. A handful of people pay for premium. Most people fill up at the cheaper pump and drive home in a car that functions identically. When the product is good enough and interchangeable, price wins. When price wins, the shovel sellers bleed, and the smart users of cheap shovels quietly widen their margins. A man I know runs a 30-person insurance documentation firm in the Midwest. No tech cachet, no press mentions. He integrated an AI document processing tool in late 2024. It cost him $1,200 a month. He eliminated 4 full-time positions that were costing him a combined $380,000 annually in salary and benefits. His profit margin went from 11% to 27% in 8 months. He didn't build an AI model. He used one. He's in the overlooked zone, quietly compounding, while the crowded zone debates transformer architecture on podcasts nobody outside the industry listens to. This is why a portion of my redeployed capital went into small and mid-cap funds with selective exposure to companies using AI rather than racing to build it. Real businesses, real revenue, sustainable margins, specific competitive advantages in industries that still run on spreadsheets, manual processes, and 30-year-old software, legal technology, healthcare billing automation, agricultural supply chain logistics, B2B software for industries where the legacy competitor is a company still using fax machines, unironically. These companies don't need to win the AI war. They need to be competent users of cheap AI tools while their competitors are still scheduling the meeting about whether to pilot a chatbot. That bar is already being cleared, quietly, without press releases. Now let me make this concrete, because abstract principles don't change behavior. Specific numbers do. You have $200,000 in a standard market cap weighted S&P 500 fund. Good position. Based on current composition, approximately $80,000 of that is sitting in 10 companies. Roughly $56,000 of that $80,000 is in the 7 companies most aggressively spending on AI infrastructure. Not by your choice, but by the mechanical operation of an index doing what indexes do. Here is what that concentration costs you in specific scenarios. If those 7 companies correct by 30%, not crash, not collapse, correct, you lose approximately $16,800 from concentration risk alone. From a portfolio you labeled diversified, if they correct by 50%, which is historically unremarkable for high multiple technology stocks when earnings sentiment shifts, that figure is approximately $28,000. You don't get to offset that against a different part of the fund because the different parts of the fund didn't cause the problem. The concentration did. Now, the restructured version. You keep $130,000 in the standard S&P 500, still your core holding, still your primary market exposure. You move $40,000 into a globally diversified fund, $20,000 into a small and mid-cap fund, $10,000 into a gold ETF. The remaining cash sits in a high-yield savings account at around 4 to 4.5%. That's between $400 and $450 per year for parking money in a place it's immediately accessible. Not exciting, not zero, bull case. Your S&P 500 position captures the majority of the upside. You leave some returns on the table by holding diversifying positions. You will survive this. Bear case. Your global, small cap, and gold positions absorb a portion of the damage. Your cash allows you to buy more at lower prices rather than sell positions to cover living expenses at the worst possible moment. You are a buyer in a panic market instead of a forced seller. The difference between those two positions over a decade is enormous. Not metaphorically, arithmetically. The people who got rich from the 2009 bottom were not the people who had predicted the crash. They were the people who had cash when everyone else needed it. The people who suffered the most were not the people with the worst stocks. They were the people who needed to sell good positions to pay rent because their emergency reserve was also in the market. Cash costs you returns in a bull market. It buys you options in a bear one. Right now, options are cheap, and everyone thinks they don't need them. I once watched a man I respected, smart, disciplined, educated investor hold his fully deployed portfolio through a 42% drawdown in 2008, while telling anyone who'd listen that he was a long-term investor and not panicking. His wife returned to work. He delayed retirement by 6 years. He recovered. But the recovery required doing essentially nothing for 6 years and accepting that his timeline had been restructured by events he didn't control. He wasn't wrong about markets recovering. He was wrong about not needing liquidity before the recovery arrived. Now, back to Buffett. Back to $347.7 billion in treasury bills. In September of 2008, when the financial system was genuinely fracturing, Buffett provided $5 billion in liquidity to Goldman Sachs at the moment of maximum desperation. In exchange, he received preferred shares, paying a 10% annual dividend plus warrants to buy Goldman stock at a discount to market price. It was arguably the best terms per dollar transaction he has ever negotiated. He could only make that call because he had been accumulating cash for years, while everyone else was accumulating exposure. A friend of mine, when I told him this story, said, so he had $5 billion ready for a phone call, and I'm over here trying to time the market on my lunch break. I did not have a good counter argument. Cash is not a savings vehicle. Cash is an option specifically, the option to act when prices are low, terms are favorable, and everyone else is being forced to sell. The greatest capital allocator of the modern era is holding more cash than he has ever held at all-time market highs, with a public platform that could deploy it anywhere. He is choosing not to. That is a statement. It is not a statement about the specific timing or mechanism of a correction. It is a statement about the ratio of current price to fair value, and it is worth taking seriously. I've raised my own cash position meaningfully relative to where it was 12 months ago. Not as a market timing strategy. I don't know when a correction happens, and anyone who tells you they do is selling something. As an acknowledgement that being wrong about AI valuations has a cost, and that cost includes possibly needing to liquidate positions at the worst moment to fund expenses rather than buying into the dip you've been waiting for. 3 specific things I've actually done, calibrated to this exact situation. 1, I verified my real exposure. I pulled up my fund, looked at current top 10 concentration, and confirmed I was making a technology sector bet I hadn't consciously made. You can do this tonight. It takes 4 minutes. If your S&P 500 fund shows the top 10 above 35%, you are making a concentrated AI infrastructure bet, whether you intended to or not. You might decide you're comfortable with it, but decide it consciously. Don't inherit it through inattention. 2, I added a globally diversified fund as a satellite position alongside my core US holding. The Vanguard Total World Stock ETF, ticker VT, covers roughly 8,000 companies across 47 countries at an expense ratio around 0.07% annually. I'm not betting against America. I'm removing the structural requirement that America must maintain its exact current share of global market capitalization for the next 20 years in order for my plan to function as designed. If the US remains dominant, the fund holds proportionally more US equities, and I benefit. If something else grows in relative weight, the fund adjusts automatically. No prediction necessary. The fund does the tracking. 3, I built my cash reserve to the level where a 30% market correction feels like an opportunity rather than a personal emergency. The specific number is personal. It depends on your income stability, your timeline, your obligations, your risk of needing liquidity before a recovery arrives. But the question to answer honestly is, if the S&P 500 dropped 30% tomorrow, do you have available capital to buy more? Or would you need to sell positions to fund life? Those two situations compound into radically different outcomes across a decade. One builds wealth, the other recovers from damage. One more thing on gold, because I want to explain why I added a position after spending most of my investing life not owning any. Under the Basel III banking framework, finalized and implemented over the past several years, gold was reclassified as a Tier 1 asset. Financial institutions can now count gold at full market value on their balance sheets, instead of applying the discount required under previous rules. This sounds like accounting bureaucracy. It is accounting bureaucracy. It also means every central bank, pension fund, and sovereign wealth fund in the world now has a structural balance sheet incentive to hold more gold because it counts better. The demand pressure from that incentive is real. The supply response is non-existent. You cannot print more gold. Gold overtook US Treasury bonds as the most widely held foreign reserve asset among central banks globally for the first time since 1996. China has been buying at record volume. India has been buying. Poland, Turkey, and central banks that rarely touch the asset are increasing allocations simultaneously. These are not retail speculators. These are the most risk-averse, most conservative, most scrutinized money managers in the world. People whose entire job is not to be wrong, changing their allocation in one coordinated direction. I am not predicting gold doubles. I am making a small strategic allocation alongside global central banks. That feels like reasonable company. It's insurance, not a bet. And right now, insurance is cheap because everyone thinks we're in a boom. The shovel trap closes like this. In every major technology transition, the people who bought the infrastructure companies at peak enthusiasm held through years of disappointment, while the people who quietly held the users of that infrastructure compounded steadily. The railroad story, the fiber optic story. The same story in every generation with different logos. The shovels were always real, the prices were always too high. The calm people watching from the overlooked zone always did better than the people chasing the obvious play at the top. Lazy investing built more fortune than crypto memes. That is still true. The boring strategy still works. But boring doesn't mean inattentive. It doesn't mean buying a product labeled diversified without reading what's actually inside it. The label on your S&P 500 fund says 500 companies spread across America. The contents currently say 40% in 10 companies, most of them in an AI infrastructure arms race priced for a future that requires them to collectively double their entire combined businesses in a category that barely exists yet. Check the label, make the adjustments that match your actual situation, then go do something else. The market does not reward you for watching it. It It rewards you for owning it correctly while you're busy living your life.